Hi there, welcome to Market Call. Our guest is Brianne Gardner. She's Senior Wealth Manager at Velocity Investment Partners, Raymond James, and she'll be taking your questions on Canadian and US large caps. You can call Brianne right now, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Brianne, thank you very much indeed for joining us. Always great to have you on the show.
Yeah, thanks for having me as always, Andy.
TSX Composite hitting a record high today. Are some of your clients contacting you and asking, should I lighten up on my stock positions?
Yeah, I mean, I think the TSX has, been quietly really delivering an impressive run outside of the US market. I think, as you mentioned, passing that 27,000 and even outpacing the S&P 500 so far for 2025. I think for the TSX, we've seen really strength in energy, materials, and the Canadian financials. And I think combined with expectations for lower interest rates have really given the index kind of a fresh tailwind. And with regards to, what are clients asking right now, seeing things hit all-time highs, I think for us, we are a little cautious. I think the big question now is whether these upcoming earnings can justify these levels, especially, we're seeing treasury yields creeping higher again. And if you're looking at earnings as we're in Q2 now, nearly half of the S&P 500 is set to report earnings in the next 10 days. So that's a big number. And I think you're including some big names, Google, Tesla, Apple, Amazon, Meta, etc. So even if you don't even own these names directly, their results, because of how their concentration risk right now, will definitely dictate, we believe, the path for the markets headed into the fall. And I think if you look at a technical side too, both the S&P 500 and even the QQQ, the more tech-heavy index, just really closed above the 20-day moving average for 60 days in a row. So that's the longest streak that we've seen going back to the late 90s. And for us, that does remain an overbought territory if we are looking from a technical or RSI level. And that's really been since mid-June. So for investors, I do think that is warranted to, being cautious, being selective, being patient, taking some profits off the table, because usually when we do see markets this kind of overbought, it does tend to lead to, sideways trending or even a sell-off, which we wouldn't be surprised to see right now.
Right. So, sorry, what did you say about the QQQ, the NASDAQ 100 ETF, solidly above the 200-day moving average?
The 20-day moving average, and I think that's been just over 61 days. So that's the longest streak that we've seen since the late 90s. And, thinking about that as well, every time we've seen this has only happened 4 other times in history, going back since, the 1975, and the average 1-year return later has been about double digits, about 22%. So that's still bullish. We are still bullish on the next 9 to 12 months, but I do think we are going to see headed into, the second half of the year. Seasonally, August and September do tend to be weak months. So I wouldn't be surprised to see, 5 to 7, 8% sell-off right now, just where valuations are a little bit stretched for us.
Brianne, it's great having you here. Brianne Gardner of Velocity Investment Partners, Raymond James, is our guest on Market Call today, taking your questions on Canadian and US large caps. The number, 1-855-326-6266. Stan has sent us an email. I've held Danaher for many years, but over the past few years, the stock has performed poorly. Can you comment? Danaher, a huge supplier to the healthcare sector.
Danaher, yes. Danaher is not a stock that I do own in the portfolios, but still, as you mentioned, is one that I think you could trade fairly successfully if you do watch the technicals closely. I think, and momentum indicators. It doesn't pay much on the dividend front. So you want to really trade this one, I think, to get the value. Flat over kind of the last 5 years and negative over last 3, especially over the last year, but lots of volatility to trade for sure. So I think it's showing the stock's down 24% over the past year, underperforming both the sector and the S&P 500. For us, looks a little bit, it was overvalued at its peak and had some definitely challenges with global revenue. I think the sector as a whole, we haven't seen performed well this year, but looking at valuations, the healthcare sector is super undervalued, and that could change. I think, the sector is expected to see some good years of profit growth numbers. So latest earnings showed 3.5% revenue, beating estimates. But bottom line fell 39% due to some, unspecified impairments there. So analysts still have a strong buy, price target 245, still suggesting 30% upside from the current levels at around that 190. But again, I rarely think it has touched analysts' expectations. So I would say don't get greedy with it, could wait for a bit, but once it hits that 220, keep an eye on changing momentum.
Let's go to Victoria. Chris, fire ahead, please.
Oh, good morning, Andy. Good morning, Brianne. I'm hoping to get your opinion on Freeport-McMoRan and copper in general. And if you have any insight or suggestions on that, that would be wonderful. Thank you both, and have a great day.
Thanks.
Yeah, thanks for the question. Freeport, FCX ticker there. Mines, as you mentioned, copper, gold, basic materials, and in the mining sector there, I think we saw Q2 earnings beat expectations, that 44 cents per share there on strong copper and gold sales. Stock trading around that 45.21, around there 45.37, up about almost 2% in July. So a mild upward trend we've seen. I think considering a solid play on copper demand, we are still bullish on gold and copper. So, but this stock is a little bit more cyclical than some of the large cap tech or utilities. Latest news I think we saw on it was that their results from Q2 exceeded expectations and guidance. And again, we still think copper pricing and strong U.S. operations are going to continue. I mean, that stock's a little bit volatile for me, but I still think there's room to run on this, and there's still some upside there. Price target about 8% upside from here.
Let's head to St. Catharines, Ontario. Dave, fire ahead, please.
Oh, hi. Thank you for taking my call.
Pleasure.
I'd like to ask Brianne about Royal Bank of Canada and where you see it going in the next year or year and a half. Thank you very much. Have a great day. Bye-bye.
Thanks a lot.
Yeah, thanks for the question. Royal Bank, Canadian staple, a stock that we do own in the portfolio, has done very well. Fundamentally in value, ranks at 8 out of 10 for us, and is still, one of the 2 largest banks in Canada. I still believe, this stock is consistent. You're still getting a decent yield, dividend yield on the stock, and I believe remains an anchor in the Canadian banking system. So, the business model is diversified, disciplined, steady. Right now, from upside potential, they're saying it's hitting the price target, but we're still on track, and we still believe the stock's on track for record earnings in 2025. The path looks a little bit bumpier, clients weighing on tariffs and rates, but I think their credit metrics are starting to, show some signs there of potentially slipping as well, modestly, especially in commercial lending. But their capital remains strong, and that's what we look at for strong fundamental companies, is their balance sheet, and their balance sheet is clean. So we continue to hold this stock in the portfolio. Again, we're going to continue to hold unless we see something change, but valuation isn't cheap. I wouldn't be buying in right now, but earnings power is real. And again, we're still being paid about 3.4% to hold this stock.
Righto. We've got Amy in Toronto. Go ahead, Amy, please.
Hi, Brianne. Hi, Brianne. My question is on ATS Corp. Recently they have a change of CEO, so the stock down about 5. I forgot it's like 5% or something. So I bought a couple of shares on that. I wonder is it a good time to add a little bit more because they seem to stabilize and move up a little bit. I'll hang up and listen to your advice. Thank you.
Thank you.
Yeah, ATS, thank you for the call. Same thing, builds those automated systems for industries like life science, EV, energy, et cetera, the industrials tech sector. We did see, a little bit of a sell-off through that April, but since has, continued to a little bit on an upward trend from a momentum, short little sell-off, but I think we're seeing that recovery. I think fiscal 2025's earnings per share, slightly down, but forecasted to rebound again. And I think you'll see that in the price. I think from April, we've seen strong support from a technical side out of this stock as well. And there's still more room to run. I think price target, we see still about 10% upside from here, currently trading around that 31.30 per share. And again, still below the 52-week high. So I think analysts are a little bit split. Some rated a sell, while others see that upside, and we are in that upside boat. So it is a stock that I still like. And yes, even though with the CEO, Andrew Hyder, stepping down, I think that interim CEO named, but analysts still remain confident in really the company's leadership, and that's what we need to continue to see. So we will be monitoring that closely, but we still think there's more upside in this stock.
That's interesting. The drug companies apparently are saying they're going to invest heavily to put manufacturing in the United States, including AstraZeneca. Wow, going to invest $50 billion allegedly in the US to fight tariffs. They are an ATS customer. And thanks. Yeah, I'm looking at a Stifel note and they had LS. I didn't know what LS was. Life Sciences. Thank you very much indeed. Let's head to Mississauga, Ontario. Frank, go ahead, please. Don't hear Frank. Costco is the question, Brianne.
Costco. Costco, great company, one that we continue to hold in the portfolio. I do like this stock. I think it's a staple. And I think that you're still, if anyone is cutting costs, whether it's Canada or the US, most people will shift to Costco. I think you have seen a little bit of a pullback lately in the stock, but I think their membership renewal has been, great and something that we are watching. I would actually, if I didn't already own this stock, be a buyer right now in Costco. Right now, the stock ranks 10 out of 10 fundamentally for us. And we're continuing to see that. I think upside potential still double digit from here, about 13 to 14%. And on the street, yes, you're seeing a little bit of a mix between buy and hold, but we are in that buyer category. And we see that the stock still has room to run. So again, I think, with their bulk qualities, bargain pricing. I'm a regular shopper at Costco and continue to go. And every time I go, the parking lots are packed. So that must be a good thing.
Okay, Brianne, thanks very much for joining us. Brianne will return after this. She's taking your questions on Canadian and US large caps, 1-855-326-6266. Amin is calling from Edmonton. Go ahead, please. I don't think we're hearing Amin. I believe the question is Brookfield Asset Management, Brianne.
Brookfield Asset Management. Okay. Bam. Yeah. So Brookfield Asset Management, same thing, reputable company, has done very well, split off a few times into some of the other sister companies there. But it is a stock that we do own and continue to like. I think that, it is hitting a little bit the BAM.TO Canadian version. I think you are seeing, it continued to hit some good levels here. A little bit short pullback, but you're still collecting decent dividend yield, about 3% there. Analysts think that the price is overvalued right now, but I think if we're looking at earnings per share, something that we are watching closely, haven't seen Q2 results yet. They did slightly miss on earnings per share, so something we will. Q4 they did beat, and you are getting again a mix between buy and outperform and hold on the street. So for us, we're in a little bit of a hold situation right now on Brookfield Asset Management.
Oh, okay. John is standing by in London, Ontario. I want to hear what you have to say about this stock. Go ahead, John, please.
Thanks, Andrew. Hello, Brianne. My question is on Capital Power, your number one pick for 2024. And thank you for that, by the way. I bought it early in 2024. It did really well, especially in the second half of the year. It started to pull back. So I sold half my position, and I bought some Constellation Energy and Vistra Energy out of the U.S. Now look at Capital Power. It's coming back. How does it rank on your fundamentals, your 2 marks out of 10 that you give it? Thanks very much.
And the stock jumping today, it got a buy rating from National Bank of Canada. Go ahead, please, Brianne.
Yeah, you know what? I think I was really happy with that top pick for 2024. Capital Power did great. Obviously had some weakness coming through till 2025 until we saw this April. And I think we're starting to see the sector as a whole turn around. From a valuation standpoint, Capital Power ranks a 9 out of 10 from a value score and an 8 out of 10 fundamentally. It's not a flashy company, but it's been quietly, I say, transforming, right? Moving from kind of coal heavy routes to more flexible, lower carbon fleets across North America. Last quarter came in strong. We saw earnings ahead of expectation, solid performance out of their U.S. assets. Something that we're watching closely. Dividend continues to grow, which is positive, and something that we look for too from a company, now yielding just over 4%, and management continues to reaffirm plans to increase to 6% annually through 2025. So again, very positive news. Still about 10% upside from here, I see, from a price perspective. So still a little bit more growth. Again, if you are taking profits, not a bad idea to take some profits off the table, but we do think there is a little bit more room to run in this. Leverage is something that we're watching closely for the stock. They have been active in M&A, but again, I think their balance sheet is strong enough to carry that.
Right, and so much optimism here, as you know, about power demand for data centers. And the Wall Street Journal reporting that more and more people are just using AI for search. And of course, AI needs more computing power and energy consumption. John, thanks for that question. Mike is standing by in Kelowna, BC. Go ahead, Mike, please.
Good morning. I'm considering playing Methanex as a trade. I'm wondering, is this a good entry point? Thank you.
Thank you.
Hi, Mike. Thanks for the question. Methanex is not a stock that we do own in the portfolio, but still ranks, from a value perspective, 8 out of 10. So not bad. Again, produces and sells kind of the methanol globally, basic materials and chemical sector. Q2 earnings expected about 42 cents per share, down 32% year over year. Again, revenue also forecasted to be down 5%. Stock trading, around kind of that level, but still down around that $35 per share there. Upside target, though, there is still, we're seeing a moderate buy on the street and a significant upside target of about 38% from us, well below the 50-day moving average and below the 200-day moving average. So for us, we would, if I was going to get into the stock, wait for a solid turnaround to see conviction that the stock was trending upwards before getting in, because I would like to see that from a technical side too, to see that momentum. Still getting a basic, a decent dividend yield there, but rated again by 9 analysts on the street. So seen as really undervalued by the cyclical space. Newest earnings are reported July 30th. So we will wait and see there, hinting at a possible upside surprise. So again, something to watch.
Thanks very much, Mike, for that question. Let's head to Fort Erie, Ontario. David, go ahead, please.
Thanks, Andrew. Brianne, just curious about Dream Industrial. Your comments would be appreciated. Thanks for taking my call.
Thanks.
Yeah, Dream Industrial is one that I do follow. Not one that we do own in the portfolio. Have actually followed it for a while. It's always one that I do watch for. Value scores a 9 out of 10. Fundamentally, 8 out of 10 for us. I would love to see this stock really turn around, and it looks like, it has had some strong momentum since that April bottom. Slowly, but it is, again, the retail or the REIT sector has been hit, and hopefully we are starting to see a little bit of turnaround in that, especially with interest rates coming down. The company manages, industrial buildings across Canada, Europe, the US in that real estate sector. I think current price, around that 1180 almost, or 1188. Still about 20% upside from here. We're seeing analyst price target about 14. So again, moderate buy, trading below its 50-day and 200-day. But again, I think they announced July 2025 distribution of 5.83 cents per unit, and that is payable in August. So, some good positive momentum behind this company. And I really hope that, again, this stock continues to go up.
Thanks for that question, David. When we come back, we're going to have a look at Brianne's past picks. One that didn't work out so far, Lululemon. That's after the break. Brianne was on our show July 17th of last year. Her first idea, Visa. This one working out nicely, a gain of 30%.
Yeah, Visa, still a stock that we do own. And I still think, remains one of the best compounders out there. We are still bullish on Visa. I think it's moved well beyond, swipe fees and really value-added services like fraud tools, data analytics is continuing to grow extremely fast, and now accounts for over a quarter of their revenue. So to us, that diversification matters behind the scenes, but the core business is also benefiting as travel is rebounding. So cross-border revenue rose 15% last quarter, key profit driver there. US payment volumes rose 8% in April, again, showing that domestic spending is still resilient, even despite some higher rates out of the US and macro uncertainty. So Visa's ability, we think, to manage through that environment stands out. Q1 profits expanded by 100 basis points and earnings per share rose 10%. So a clear sign of their discipline. Stock trading at 31 times forward earning isn't cheap now, but we think you're paying fair price for this stock.
United Health. Health has been a tough category. This one down 49%. People partly worried about regulatory changes in the United States.
Yeah, United Health. So we actually averaged down on the stock and did a buy at around $273 per share in May. So that brought our own cost base down to about $400. Right now, $424 was our average back July 17th, as you mentioned, starting price. So even where you are today, plus the dividends, yes, we are down still on the stock about 31%. But, the stock has been under a lot of pressure. Everything with the CEO, I think but it's still the largest U.S. healthcare manager, and we still think they have a strong vertical integration. So yes, guidance was cut, earnings per share outlook dropped. We did see the stock fall, but adding into that weakness, we think valuations are compressed. They're under 11 times forward earnings, despite 13 to 16% long-term earnings per share growth targets. So we see it as a high-quality compounder and still more upside from here to go. So for us, still ranks a 9 out of 10 and something we see about 25% upside from here.
And then Lululemon. Now, this stock has suffered. People worried about competition and other things. But you say that you did sell at just north of $400 in early December.
Yeah, so Lululemon, when I was on, was more of a trade play for us. We saw the stock super oversold last time, and people were like, this is a bottom feeder stock. We wanted to use this as a trading opportunity. Again, being active managers, we will make some active trades in the portfolio. So we did exit Lululemon back in December, and for us, that was a great call, and something that we did take pride in. We were up almost 37% on that, and took our profits off the table. So, we did see consumer discretionary space a little bit going to be under pressure and wanted to get out of Lulu. And again, not being greedy. So we did do that. We trimmed it actually twice before we fully sold. So again, we saw international sales grow 21 in China, 20% elsewhere. Global momentum was building. Margins held up despite inventory headwinds. I think pricing power does remain strong. Stock now trading below 17 times forward earnings versus 27 their 5-year average. So, the stock looks to be a little bit undervalued again. They still have a clean balance sheet, zero debt, 1.3 billion in cash, and 1.6 billion in buybacks. So you're still getting premium name at a discount. We're staying cautious on the stock right now, but definitely back on our radar. So overall, I think between those three stocks, we still totaled about 34% average return, about 11 based on our active management.
Okay, we are going to take a break, and we'll get more from Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and US large caps. Let's head to Toronto. Paul is on the line. Fire ahead, Paul, please.
Yes, good afternoon. I just like to know about Tesla. Like people are saying, the 350 range is to be taken care of. Like, would it sustain 350? It can come down or go up. So I just like to know your views about it. And thank you. Have a great day.
Yeah, thanks for the question. Tesla is a stock that we have traded a few times. I would say, again, very volatile stock. If you look at the chart there, even over the past, 1 year and 3 year, I think Tesla's story, is shifting a little bit. It's no longer about rapid EV growth, but about managing its scale. And I think defending margins and finding the next growth level. I think Q2, we saw deliveries fall about 5% year over year, but still beat reduced expectations. Price cuts did help, but continue to pressure profitability. We see limited near-term upside from here. Just from a value, it's about a 2 out of 10 for us. I think holding around that 180, and we're looking, about price target there as margins are compressed and really rising Chinese competition. We don't own the stock. Again, name we have watched and trade closely, but for now we prefer, I think, more high visibility. I think there's a lot of political noise with Elon, and I think that is also hitting the stock as well.
Thanks very much for that question. Jacob in Toronto, go ahead, please.
Hello, yes. Good afternoon to both of you.
Hi.
If I may ask Brian about Brookfield Renewable Partner.
Brookfield, Jacob, Brookfield Infrastructure?
No, it's Brookfield Renewable Partner.
Okay. Brookfield Renewable. Thanks very much. Any thoughts on the renewable?
Yeah, so I think BEP.UN, I believe, is what we're looking at. So again, still diversified, multi-tech owner, operating in that clean energy space, as you mentioned. You're getting a decent dividend yield, 5.5, 5.6%. Not a stock that we do own. I think even looking, the past 3 years, it's been underwater. I think they're trying to get this momentum. And I think, globally between wind, solar, storage facilities, et cetera, in North America, we just haven't seen it in the price price yet. Price target upside from here on the stock, about 5%. Looking at earnings per share growth and revenue, have been down. Again, a stock that we don't own and would, until we see some actual strong numbers out of this company, we would stay away from it.
Okay. Peter is in Vancouver. Go ahead, Peter, please.
Thank you. Great show.
Thank you.
Great host and great guest.
Thanks,
Brianna,
Peter.
can you help, please? Me and a group of retired seniors are in over our investment in BCE.
BCE?
Stock prices dropped sharply and dividend cut in half.
Okay. BCE it is.
Yep, BCE. So not a stock that we do own. And thanks for the question. But still, has been underwater too a little bit over the past 3 years. Company has been, I think, a little bit tight, and we saw earnings per share fall from that 350 to 304. Free cash flow has also declined, trading around kind of that 23, 24, but analysts average a price target of about 36%. So 55% upside, potentially, I believe, from here. For us, we don't see that much. I think, we could see, about 4% from here on the Canadian side. And I think, analysts are ranking it a hold, and dividend was cut, as you mentioned. And I think they cut the dividend. They needed to improve financial flexibility. Instead, we own TELUS over BCE, and I think BCE is still restructuring a lot, reducing their debt, which is great to see, and investing in kind of that 5G digital media after that dividend cut.
Okay, and BCE, the parent company of BNN Bloomberg. We're going to be back with Brianne Gardner of Velocity Investment Partners, Raymond James, taking your questions on Canadian and US large caps. Nazar in Scarborough, Ontario. Go ahead, please.
Oh, hi, Andy. Hi, Brianne. May I have your thoughts on freehold royalties, please? The stock price has been range-bound for quite a while now. It has moved slightly upward lately. I recall you hold this stock. Is the dividend safe? Thanks for taking my call.
Thank you.
Yeah, thanks for the question. Freehold, yes, energy royalties, which we do like. So no drilling, just collecting oil and gas income. Earnings per share about 98 cents. PE about 13.3. So, we see it as great value. Dividend yield of about over 8.2%. I think you're still getting a strong income play. We don't see signs of cutting dividend as of now. I think stock is trading again around kind of that 13.25 mid-range of their 52-week band, so neutral trend. Analysts do rate it a hold, though, so modest upside versus peers. I think they did declare their latest July dividend, so that was good to see. And I think Investor Day did emphasize U.S. growth and strategic consolidation, seen as a long-term play. So for us, Q4 production rose 10% year over year, dividend hiked, income investors took notice. So still a stock that we like.
Right. We're having a little bit of trouble with our graphs right now, but freehold royalties, let me just look at the one-year return on that stock, FRU. It is down over the past year, but you've had, including the distribution or dividend, a positive return of 3%. Nazar, thanks for the question. Frankie is standing by in Brampton, Ontario.
Hi, Andrew. Thanks for taking my call.
Pleasure.
And Brianna, thanks for on the market call. We really value your opinion. I wanted to ask you how your company and yourself are positioned for the AI boom. More specifically, is AMD. What do you think about AMD as a second cousin, which is usually forgotten behind NVIDIA? Is this something that can be provide a good value for the next year or so? Thank you.
Yeah, thanks for the question. Appreciate it. AMD, yes, I agree, kind of in the shadows a little bit, still chasing NVIDIA, but is still carving out its lane, I believe, in kind of AI accelerators, so custom chips, adaptive computing. Q2 earnings beat just by a hair, but still a beat. We saw data centers revenue up 80% year over year. Client and gaming segments remained a little bit soft, fundamentally ranks an 8 out of 10 for us. I think that chip momentum is real. I think they're guiding to over 4 billion in 2025 sales. So a sign that they're gaining shares in that AI arm race. So, good for them. I think the stock is going to continue to benefit. We are on a consistent upward trend since that April sell-off. Just launched their new AI model generator that runs locally on laptops. Early proof that their edge in AI continues to be real and push. Yes, we prefer NVIDIA and own NVIDIA because of its ecosystem advantage, but, things could change.
Okay. Let's go to Valerie in Saskatoon. Valerie, go ahead, please.
Oh, hi there. Thank you, BNN, for taking my call. I'm a present shareholder of TELUS, and what I'm looking for is some expert opinions in analyzing the stock, and I will hang up and listen. Thank you so much.
Thanks.
Yeah, so TELUS, again, I did briefly mention that when we were talking about Bell or BCE, is a stock that we do own, but have actively traded it as well. I think it was hit hard, obviously, by rising interest rates, but rates also a little bit of an overvalued at $30, so undervalued at $20. That's kind of our price range we see the stock trading around. Still Canada's second largest telco, owns telco or TELUS Health and TELUS International. Q1 revenue up 3%, free cash flow up 22%, dividend yield and growth guidance of about 3 to 8% annually through to 2028. Again, that's good. Some people are worried about the dividend for a while. I don't see it being cut. At least not right now either. Stock trading at $22.50, up 15%, recovering off those 2024 lows, but still well below 2022. For us, it's a hold. You're getting a decent dividend yield from it as well. In a business you don't have to worry about. Steady earnings, strong consumer retention. So again, we still own the stock. We continue to train it and are a little bit active on it.
Oh, my goodness. We're running out of time here. We'll squeeze in one more caller, Anne in Scarborough, Ontario.
Brianne, would you consider Qualcomm a growth company, and would you buy at this price? Thank you.
Thanks.
Okay, I will try and fly through. Qualcomm, I think it's still, company remains a key enabler of kind of the mobile connectivity. And hands down, I think still drives about 75% of the revenue. The business is evolving. Fundamentally, the stock rate's a 9 out of 10 for us. Upside of about double digits, 11% for here. We saw June quarter look solid, 10% revenue growth. Long term, Apple and Samsung are moving towards their own chips, but that transition is gradual. So I think Qualcomm can still participate. That does give them time to be adapting. We're watching closely. We don't own it today, but we see potential opportunity if diversification does stay on track and margins hold up well.
We're out of time for calls, but don't go away. Brianne will be sharing her top picks next. Join us tomorrow on Market Call. Our guest is John Zechner, chairman and founder of J. Zechner Associates. He's taking your questions on North American large cap stocks. Now, if you missed Market Call, that's kind of a weird science fiction premise. That would never happen. Check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can watch full episodes on our YouTube channel. Let's get to Brianne's top picks, starting off with Abbott Labs. It's something of a juggernaut in healthcare, including devices, Brianne.
Yeah, and I know, we talked about the healthcare sector before and a little bit, feeling the pressure, especially the first half of 2025. Abbott really is a diversified healthcare giant that does operate across, medical devices, nutrition, and branded generics. So over 60% of sales come from actually outside the US, making it one of the more globally balanced names in the sector. Fundamentally, it ranks a 10 out of 10 for us. We see the medical devices division is really, hot and heavy, 10 straight quarters of 10% plus growth, with really momentum in areas like heart failure, epilepsy, and diabetes tech. I think offset some of that strength. Diagnostic has come under pressure, and that's expected to drop. I think with COVID test, created a tough year-over-year comparison, and we did see China's procurement really changing after weighing on volume. So Abbott is responding by focusing on growing its core lab testing platforms and expanding its molecular and rapid diagnostic footprint in non-COVID areas. So yes, the stock pulled back a bit despite steady margins and no change to full year earnings guidance, which is good. We think it creates an opportunity, and I think Abbott still trades a little bit out of a premium, but on stronger ROI forecast and consistent with historical average. So again, we see upside potential of about 14% from here.
You touched on this, but the stock not cheap.
Yeah, I think if we're looking at historic valuations, P ratio, forward P of the stock about 24 times. So something that we do definitely monitor, but it has had a little bit of a pullback recently off the peak. So for us, that's not a bad entry point for someone looking to pick up this name. And I think, analysts across the street overweight on a buy perspective. And again, we see double-digit growth. So still about 14% upside from here, and earnings growth expected, or earnings growth annualized 1 year 135%, 3 year 25%, and 5 years earnings growth has been about 30%. So, still great company that we see more upside in.
Your next idea is Chipotle Mexican Grill. You think they're a standout in the restaurant sector?
Yeah, I think Chipotle, it does continue to remain a standout in the restaurant. I don't know if you eat there, but I think combining their premium branding with almost that fast casual convenience, their positioning does appeal to kind of a broad demographics, especially younger consumers that are more focused on kind of quality and sustainability, but also that fast food. So they have same store sales are expected to grow 6 to 7% this year, with traffic doing the heavy lifting. So a sign that the brand still has pricing power without kind of alienating its core consumer. So their store expansion is aggressive, I think, but disciplined. They plan to open 300 new locations this year alone, which now drives, again, stronger margins and faster payback. So efficiency is key to the story. Automation, smart grills, digital make lines, and we see that continuing. Still, again, stock isn't cheap, but we think it's justified. They do have a track record of execution, clean balance sheet, and a long runway, both in North America and abroad. So they actually report today after market. We are expecting another beat. They did beat the last 9 quarters, so something to note there. And again, revenue growth 1 year 14, 3 year 14, 5 year 15. So consistency there, upside potential of about 16%, or a price target of about $61 per share.
You may know that Chipotle is opening in Mexico, and some people might think, oh, that's a travesty. But I asked a Mexican person about it, or a person originally from Mexico, and she said, well, yeah, but Mexicans might be curious just to see, what is their take. Why not? In any case, it's sort of like when you see Starbucks in Italy, though, I'm thinking, oh, no, do you really need that? Anyway, Motorola Solutions. They were famed years ago for their flip phones. Why do you like them these days?
Yeah, and I still was in the era of the flip phone, so I did have one of those. I think most people remember, as you mentioned, those flip phones, but today the company is more about keeping the city safe and connected. 2/3 of the company's revenue comes from radios, video surveillance, and really those center hardware systems. The rest is higher margins, so software services, cloud-based emergency response. But really what's interesting about this story is that the last part, the software side comes, they have long-term contracts that support strong profit margins, reliable cash flow, and we like that reoccurring nature of their business. I do see, they did recently an acquisition, Silvus Technologies, which does bring advanced wireless tech as a positive, expands their reach into kind of some higher growth areas like defense, automation systems, etc. I think financially, if looking at the company, they did post Q1 earnings beat, raise their guidance for 2025, which is great, and now hold $14 billion backlog. So for us, that's strong momentum for an $11 billion business. Margins are expanding, better than product mix and cost control. And despite some of the tariff noise that has been going around, we still see that they have steady earnings growth ahead. So for us, it's a defensive tech name, but has a clear edge. So market cap, ranks at 8 out of 10 for us, consistently between revenue growth annualized over the last 1 to 3 years of about, 8.5 to 7. So still consistency there. Dividend yield, not a huge dividend you're getting from the stock, but we still see upside potential of almost 20%.
That's interesting. And you say it's rare for a tech stock, a reliable cash flow, and then it has that growing software backbone. So something of a steady eddy.
Yeah, I think you have seen some volatility in this stock for sure, but it is a stock that we are watching closely and looking to see a turnaround in kind of the performance, even if we look at the 1 year. And I do think that we will see that.
Sure. Brianne, thank you very much. Always great to hear from you.
Thanks for having me, Andy.
Brianne Gardner, thanks for watching Market Call. Remember, John Zechner is up tomorrow. Have a great day in the markets.